Sweet. Are you sharing your screen? Just go ahead and share. All right. You guys can all hear us well, right? Yeah.
Yeah, we can. It's great.
Are you going to share the screen, Chris?
I am going to share the screen. Here we go.
You're just sharing one screen?
Say what?
Okay, never mind. All right.
Perfect. Well, we are recording. And yeah, thank you guys so much for joining us for our webinar on the Executive Arms Apartments. We are extremely excited about this opportunity. It's 25 units in Northeast Portland, which we think is a kind of a growing area that is, I don't want to say gentrifying, but it's certainly coming up quite a bit. It's pretty close to the airport, which is becoming more and more desirable. I'll pull up Google Earth of it.
Can you guys see that Google Earth?
And you can kind of see it's right here, right next to an elementary school, and then as well next to Montevilla Park. And you know, it's a pretty decent neighborhood when you look at the area. And so currently it's been owned by a very, very long time landlord. Joe Weston owns, I don't know how many units in Portland, but it's in the thousands. And he is liquidating his portfolio and selling to donate to charity. And so he just wants to see these deals close and is offering a pretty fantastic return on these properties. So yeah, moving on into the presentation, we are gonna just kind of go through the PPM here. AJ, you want to jump in on the executive summary?
Yeah. So the purchase price is almost 3.3 million, and we're looking to raise about 1.1 million.
A little less than that.
Yeah, a little bit less than that, $1,075,000. So, you know, our plan is to
raise rents.
There's a bit of deferred maintenance on the exterior. We believe that a new roof is needed. The siding that's kind of cedar shake up top needs to get replaced. A lot of the units on the interior haven't been touched in a while, so we anticipate a fair amount of turnovers as the property turns over, and also as we raise rents. So I think that the plan would be to raise rents, and as the turnovers happen or occur, we'd be fixing them up. I don't think we're going to be giving no-cause notices or anything like that to get people out and do renovations. So the renovations will just kind of occur as they come available. So yeah, it's one building. It's got kind of a courtyard. There is dedicated parking, which is nice. I believe that there's 24 spots, which is just one less than all of the units. We're going to be raising about $260,000 of capital to do those turns, along with the roof. So yeah, what do you want to go next?
Sure. Once we've completed our value add plan, we expect the property to be worth about 3.9 million. Currently rents at the property are roughly, I want to say the 2 bedrooms right now are at about $1,000 a month, and market, you know, I would put it at 1,300, but we underwrote at 1,195. And actually I can pull up the pro forma just to get a quick look at the rental comps. We're just going to look at the rental comps right here and kind of see the premiums that we're looking at. So there's a laundry room, and it makes, a little bit of money every month. But each, okay, yeah. So studios, there's a little bit of a smaller premium. The 1 bedrooms are a little closer, but when you look at the 2 bedrooms and then the townhouses, there's quite a large premium. And so we kind of have 2 options with our value add plan, is that we could pick like maybe a third of the building and, increase those rents kind of on day 1. And, maybe the rents that are a little higher, so it's not as big of an increase. And then kind of do it in thirds so that we'll be up to market by year 3. Or we can implement just implement RUBS right away and kind of go with a more slower plan. Okay. Can everyone see the pro forma we're looking at?
No, they can't. So I think you just want the screen. Can everybody see the pro forma now? Yeah, they can.
Okay. Sorry about that. Yeah, so we're looking at the premiums for the units, and you can see we've got 22 bedrooms. So there's quite a bit of rent premium to be achieved once we implement the value add plan.
And to also comment on that, one of the reasons we like this project a lot is because it is mostly 2 bedrooms. There's a lot of development in Portland that's happening, but it's catered more to that like 0 bedroom studio and 1 bedroom. So we feel like the economics of the 2 bedroom really bode well for rental increases, and it's just more space and it's more sought after because there's less supply of it.
Yeah, and these 2 bedroom units are actually quite large. So the townhomes, I want to say, are around 1,000 square feet, and then the 2 bedrooms are 875 or 850, and that is a lot of space for any type of new development.
And the townhomes have a half bath on them too, right?
Yeah, those are 2 bedroom, 1.5 baths. So this is just kind of the opportunity that we're looking at and that we're excited about. And so that's how we believe we can take this property that's about $2.4 million and increase the value to $3.9 million over the course of 3 to 5 years. And yeah, so
purchase price is $3.3 million.
What? Oh, no, it's not. It's,
yeah. Oh yeah. Okay.
It's about 2.4 million. Let's
3.3.
3.3. Yeah. Okay. I'm off. Okay. So that's the loan size.
Yeah.
The loan size is about 2.4. Okay. Yes. So that, creating $500,000 in value, once our value add plan is done, is going to be very easy to achieve. And
we definitely think that we've underwritten this very conservatively. We know that there's a lot of updates. We've got a lot of capital in there to take care of those and achieving those rents. Again, I think that the area probably will serve higher rents than that.
So we're projecting a 4.45 exit price
after 5 years.
After 5 years. So that's kind of, I got a little confused on my numbers, but the purchase price is 3.3, and then we believe that we can increase the value of the property by 1.15 million. And the reason why we think we can do this is because we have opportunities in these rent premiums. There's a lot of space in each of the units, And we have the ability to bill back utilities as well and get the expenses for the property down. So that's why we're excited about this deal. And yeah, so we're offering a 7% preferred return. And then above that 7% preferred return, there's an 80-20 split up to an 18% IRR. And then above an 18% IRR, there is a 50-50 split between the limited partners and the sponsors of the deal, which is AJ and I. And yeah, so are there any, this is kind of, let's dive a little bit more into the value add plan.
Sure.
So where's the construction?
Keep going down.
There we go. Okay.
That just describes the.
So here's our building. You can see that the roof does need work. We've got all this extra parking in back here and about 6 spots in front. And then I think there's about 16 in back, which
18 back.
Okay, 18 in back. And yeah, all right, here's our value add plan. And first thing in the value add plan is to implement RUBS. We're still toying with the idea of risking relocation for a third of the building and then kind of doing that
So for those
3 years in a row.
For those of you who aren't familiar with Portland, this is inside the city of Portland, and they have a relocation assistance program. So if it states that if you raise the rent over 10%, then you have to be willing to pay this relocation assistance to a tenant. So what we find is that sometimes if the premium is large enough, that may be the best opportunity. And for the 2 bedrooms, I think it's right now relocation's running, is it 4,200 or 3,500?
It's either 42 or 4,500.
But the tenant has to move out, and or if they want to stay, they can just pay the rental increase and they don't get any relocation assistance whatsoever. So oftentimes if we're raise the rent to just under market, a lot of the times the tenant sees that the rest of the market is, they can't find a place that's lower. And so and we've had tenants end up staying in that situation. So that's kind of like the best of both worlds if the tenant decides to stay. So that's one of the kind of the nuances of being in Portland. And it allows for us to kind of maneuver if we do need to raise rents up a little bit higher. So it just kind of depends on what the tenant decides to do.
And this is one of the things that makes great deals available in Portland, because the rent control and the Portland relocation costs rules are so nuanced, and to successfully navigate them takes, pretty much being a property manager and working in the property management business in Portland every day, because it does change relatively often. So Rob wants to know, is utilities considered in this 10% max increase? Yes, it is. In the city of Portland, and it's actually a 9.2% increase, because the state of Oregon CPI was lowered to 2.2%. So that we're capped at 9.2%. Otherwise, we risk having to pay relocation costs, and utilities are considered a quote unquote associated cost. And but the thing is if the tenant moves out of one of these units, we decide to raise the rent to, probably within 10% of market. So like on a 2-bedroom, that would be if we're going back to the pro forma, it would be increasing from $965 to say, $1,100 plus utilities. So it would be roughly a $200 to $250 rent increase. And, you know, that is a very competitive market rate, especially, you know, in these times when it's so difficult to find a place to live. So what would be the downside is if all of the tenants moved out and we had, you know, an extended period of turnover. And I think that that's something that we're willing to risk on, you know, a third of the building. So, yeah. And as each unit turns over, we've kind of put together an upgrade plan. We're going to be kind of keeping laminate countertops, and we'll be doing kind of slight updates on the kitchen and then hard surface flooring throughout, trying to keep as much trim, floors and doors as possible. And these, if we look at the budget, do we have the budget here? Here we go. Okay. So, yeah, if we're looking at the budget, I mean, the majority of the cost that's coming in is from the roof. And, you know, we have done quite a bit, or we've added quite a bit in for Cynthia wants to know if there's any affordable housing requirements. There are not any affordable housing requirements, but we have no problem accepting Section 8 as long as the tenant qualifies. And, you know, that's, you know, like, it's essentially guaranteed funds, and the tenant is very interested in maintaining the property so that they can keep their voucher. Yes, there's no HVAC. It's all baseboard heating. So that is a plus at this property. And as far as utilities,
so the big one that typically gets put into the RUBS system is water. So there's typically one water bill that comes in for the property, and then that has to be parsed out to the tenants for RUBS. And usually that's the largest one. I believe that there are separate electrical meters for all of the units.
Yeah, there separate electrical.
No gas. And then there may be some common electrical from the just the exterior lights and stuff.
Yeah, common area in the laundry room.
In the laundry room as well, which will get parsed back to the tenant.
But we've got quite a bit of the construction budget is remodeling units.
Yeah.
And new cabinets, flooring, plumbing, electrical, countertops. So
we got painting the exterior in there after we do a little bit of the siding repairs up top. That cedar shake up top just needs to be replaced. And we're going to do that with the roof, probably get new like flashing on top as well. So, I mean, a significant amount of the budget goes to the exterior. You know, probably looking at, was that almost $65,000 going towards the exterior. And then the remaining 200 then would be going to the interior of the units.
Cynthia wants to know about the inspection. Yes, I was out there for the inspection. I inspected every single unit, and we scoped the sewer. We had a roof inspection and an exterior and siding inspection. You know, we identified that the roof needs to be replaced, and the sewer scope was fine. And the building itself, like the structural, is solid. And I mean, other than some of the units being outdated and just needing to be upgraded, we didn't find anything that was non-structural.
The one thing that we will
non-cosmetic.
we said before is we're buying this from a landlord that's been a professional property manager in the Oregon area for over like 50 years. So they're notorious for taking good care of their properties. So overall the property is in fairly good condition. It is outdated, and I think that they didn't want to take on a large project to redo a bunch of units before selling. I think he's just kind of gotten to the point where he's old and he is getting rid of thousands of units. So this happens to be just one in his portfolio that they hadn't touched as far as renovations for a while.
Yeah. So we already talked about kind of the comparable rents, but let's hit it again. These are for comparable apartments. So if these units were renovated and we spruced up the curb appeal a little bit, the market rent over the past 12 months has been $14.74 in the area. And, there's a pretty wide, rate, like it's pretty wide when it comes to the bottom 10th percentile to the 90th percentile. So we really believe in the rent premium, and we underwrote the deal with conservative comps.
We're very conservative on the rents, as you can see, like that 10th to 90th percentile. We're at the bottom percentile on this property. So we firmly believe that we're going to be able to get it up to our pro forma rents like very easily.
Okay. Yeah, and as far as the structure of the deal, so we send out our PPM, and that's kind of like the initial prospectus of the investment. And then as we take in soft commitments, we earmark investors down, and then about 2 weeks before closing, we ask for the hard commitment. And yeah. Oh, you want to talk about the loan, AJ? Go for it.
Well, Derek asked about the terms of the loan. So we just locked the rate today. Is that
right? Yeah, we just locked the rate today. So we paid the rate lock free, which was 1%. So we're dialed in for that.
And I think that we actually improved upon this. I think we rate locked at 3.15%. They are still underwriting the loan. So our LTV is still kind of up in the air. So there may be some tweaks to what needs to happen here. So we're not 100% sure on that. This is the first time that we've used this bank, but they've become highly recommended. We're using Umpqua, and they have done tons and tons of multifamily and also in the area. So,
yeah. We're one of the great things about this loan is that the prepayment penalty is the prepayment penalty, I believe, is not yield maintenance. That is something. Yield maintenance is what our previous lender charges. I want to say it's a 4.321, which I'll need to double check on it. But from my understanding, the prepayment penalty is a little bit lighter, a little easier than the Freddie Mac small balance. So, yeah, it's a good deal. Oh, and the other great thing about this lender is the COVID reserves. So the lender does want 6 months of COVID reserves, but the COVID reserve is used to pay the interest and principal for the first 6 months. So we get 6 months of extra cash flow as we're turning over units, doing work on the roof, and kind of cleaning up the property and increasing its value. So the cash flow over the first 6 months will be pretty good. Yep.
We are the loan guarantors.
So you're looking at the loan guarantors.
We don't charge for it.
Yeah. So we want to talk about the parking. Let's jump on Google Earth and have a little, closer look at the building. So I wonder if I can get it to swivel around. Yeah. Anyway, there's 18 spots in the back here. And then there might be 8 spots up front, but then there's a ton of street parking. So this is a church right here. And there's, tons of street parking along here.
You got parking for the elementary.
I don't know if they can park in the elementary school, but along this area you can park. And then there's just tons of off-street parking.
So I think Cynthia's question was, were we going to monetize parking? And I think that is a possibility. And as we get into it, assigning spots and then monetizing it is definitely something that could happen.
Yeah, certainly.
We haven't considered it fully. And we haven't underwritten it because we don't know that that's the exact plan, but we will certainly take it into account, and it's a possible upside that could happen. The issue is though there is a ton of extra parking there that is available to the tenants, so maybe we may just assign the spots and not monetize it.
Okay, so let's dive in a little deeper on the finances. So actually with the new rate lock, our estimated IRR has jumped up to about 18.3%.
Go to the pro forma.
Sure, we can jump into the pro forma. So here is the pro forma and our budget, our COVID escrow, closing. Oh, the other great thing about the loan is the closing costs are so low.
They don't have an origination fee, right?
Yeah, there's no origination fee, and they limit all of the appraisals and environmentals to $4,500 for the loan processing fee. And yeah, it's a great deal.
It's a good deal.
Okay, so existing expenses are about 34%, and with billing back utilities to the tenants, which is the first thing that we're going to do, we're also going to increase the maintenance and repair budget, but the plan is to take care of the deferred maintenance, but we just expect that there's going to be turnover costs in the budget. So we have added this in to the stabilized budget. And so we just by billing back utilities is where we really think we can gain some value. And I actually just got the insurance quote back today, and the insurance quote was $3,500 a year. So that's another a little drop in expenses that we're exciid to get. I don't know how Joe Weston gets a $1,900
probably self-insuring
a $1,900 insurance policy.
To that in a long time.
But when it comes down to that, and once we have our rents up, we're expecting a $244,000 net income. And so in the first year, we increased the vacancy on on that year because we
anticipate turnover, tenants moving, some renovations happening. So.
Yeah, and we're also increasing rents. So the rents, just, you know, we're not going to be able to get all of the rents up immediately. Okay, and
we also have in year 2 an 8% vacancy
because
knowing that year 1's going to carry over into year 2. And these are just examples of like what we're doing to make sure that we're conservative. Like we want to be absolutely sure that we are going to be hitting marks. And you know, this is going to be a great deal for sure.
So we are really only projecting that year 3 we're going to be hitting kind of the stride of our stabilized property. So yeah, and cash on cash for the first year with a 40% expense ratio is 7.8. So that'll hit our preferred return. And the preferred return gets paid out quarterly. And it's so it's like 1.75% of the principal balance paid out quarterly. And if the property and we've completed the value add plan and it starts to accumulate cash flow, we're going to disperse that cash flow, keeping a little bit so that we'll have enough to turn over 1 or 2 units. But I mean, what we really don't want to do is disperse all of the funds and then need it for like 1 turnover. So we haven't had a capital call yet, and we don't expect to. We raise plenty of funds for our value add plans and our improvement budgets. So yeah, looking at the IR or the cash on cash it looks good. And so there's a solid ROI, solid return in the first year. Yeah. And that's how we get the IRR that we're expecting and the cash on cash. Okay. So there's the finances, and yes, this is an investment. There are risks involved. We won't go through them all, but if you have any questions, we're very happy to answer them. And I think that is.
Should we open it up to any? Do you guys have any other questions for us? Tax benefits for the LP. We do plan on doing cost segregations on these. For the first 2 syndications that we did, just to give you an idea, on a $50,000 buy-in, we had a negative $40,000 loss in the first year. So the cost segregation front loads all the depreciation. So it is a good haven if you have other real estate investments or considered a real estate professional.
Oh, hey, Dan. Yeah, they're solid tax benefits. When are you expecting to raise the rents? So we were kind of discussing those options. We could pick a third of the building and just implement, 90% of market rents, which would be, between a $200 and $225 increase plus rubs. So we could pick a third of the building and then implement rubs on all of the other units. And then, or we can implement rubs and then we would have to wait 12 months and then we could increase rents, whatever the 9.2% is. And then we can increase rents again after 2 years to that 9.2%. And I think that would get us to about 90% of market rents. And that's kind of like where we want this property to live, is 85 or 90% of market rents. We want it to be a good deal and we want it to stay occupied. That's kind of our investment philosophy. We're not trying to push the like the max market rent. We want it to be a good value for our tenants.
Kelly had a question about moratoriums due to the pandemic. Currently, the moratorium seems like it's going to end on not paying current rent July 1st. Haven't heard any rumblings about extending that, but then the tenants, I still believe, have 6 months after that to pay.
Or it might even be a year.
Might even be a year to pay that back rent. So we're hoping to get back on track here very shortly. But you know, that stuff still is up in the air. You know, the politicians are really trying to figure out a way to kind of soften the blow, because there is a good amount of people that are going to have a significant amount of money to owe. The state did come up with a landlord fund, and we actually just received some money for one of our other properties on it, which was great. They provided assistance in a way that the landlord received 80% of the outdated funds or delinquent funds, and then would have to forgive 20% of it. And ultimately, you know, for someone that you know is just not going to pay, that's a fairly good deal in our opinion. You know, probably don't want to be yelling it on the rooftops to everyone, but yeah. You got any comments on that?
Oh yeah, it's just our second syndication. We inherited a tenant who hadn't paid since March, and the landlord compensation fund came through for, I think it came through for $12,000 on that property. So, you know, we're not counting on that, and fortunately, none of these tenants, of all 25, you know, they're all paying their rent. I guess the interesting thing, when I inspected the property, I was either interrupting people who were working from home, or they were gone. And I mean, honestly, there just weren't that many people, that many tenants at the property, which
bodes well.
Considering we were inspecting at 11 a.m., definitely bodes well that we've got a solid tenant base. And since the property was professionally managed, I think, you know, based on my inspections, I think that we've got a solid tenant base at the property.
Good. Cynthia had some questions about milestone dates. So we are taking commitments until it is full. We've raised $1 million. And let's see, funds submitted by and closed by. So we are currently, are we set to close on May 8th?
No, we extended. We're closing on June 11th.
June 11th
is the close date.
So we'll probably be, we'd like to see those funds wired into escrow 2 weeks prior to the close date. So we'll be looking to have people wire funds probably middle
to late May. Okay. Derek wants to know if the market turns or it doesn't make sense to sell the property in 5 years, what's the backup plan? Well, if something like 2008 happens, you know, it's a possibility, but I find it extremely unlikely. Then we would probably hold the property a little bit longer. The one thing about, you know, the market turning against us is that rents generally aren't affected that much. And since Uptown Properties is going to be professionally managing the property, we are going to maintain the occupancy and the cash flow to the maximum amount possible. And, you know, once we're able to kind of capture some of those rent premiums, the property is going to be producing quite a bit of cash flow. And
and also, I mean, additionally, as sponsors, we're incentivized to increase and reach that target IRR, because after that IRR is when we get compensated more. I mean, to be honest. So, I mean, our goal is to get a project up and going and stabilize as much as possible and really hit those above and beyond those targets.
Yeah. I had a train of thought. Okay. But all right. Other than the risk of initial investments, what other liabilities does the LP need to consider? Since it's a limited liability company, the damage is limited to the initial investment.
Yeah.
AJ and I are guaranteeing the loan. So, we have a little more risk in the deal, but we're also the active partners and also have a little bit more reward if we hit a home run. And so that's why we really like this property.
All of our syndications, each asset that we do gets set up in a separate LLC. So if you haven't participated with us before, that is a separate LLC that obtains the loan, and then we guarantee that, and then there's no other assets or anything else that goes into that LLC. So it is specifically made for the particular asset, and then that's it. Cool. All right. Is there any other questions? No.
Oh, so I was kind of remembering what I was going to say for Derek's question. Like, if the market turns, there is a possibility that we could hold the property longer, but since we'll have performed a value add plan and invested quite a bit into the property, I would expect that our value is going to be higher than what what we're purchasing it at right now. It might not be much higher, but when we hit that 5-year mark, we'll probably discuss what it would look like to refinance and get some of the capital back in the hands of our investors if the sale does not sound like the perfect idea at the moment. And we want to be returning as much capital as possible. Honestly, over the next couple of years, I'm expecting rents to go up a little more than average over the next 2 to 3 years. So probably 5 to 7%. City of Portland had a 6% rent decrease, which is the worst in history as far as I can ever go back. Even worse than 2008 and 2009. So, yeah. Are there any other improvements made in the direct neighborhood? So this is a quite an old. It's right there.
Here.
Hold on. Let me see if here's Google Earth. Okay, so it's just a really well established area, Rob.
You can see.
There's that's Gleason right there. There is some room for Gleason to kind of get upgraded, but it's not happening at the moment. I mean, you can see Mount Tabor is relatively close over there on the left here, right down here. That's probably 10 or 15 blocks away. And then you've got Montevilla, which is a great little neighborhood right in here. And, it's just kind of a very, very well-established, older, good neighborhood. Like all of these, it's mostly all homes. So I think the location is good. And that's one of the things that makes this property a good one. And it's right next to a school and right next to a park. There's plenty of parking. It's
easy access to freeways for people to get around. There are stores and shops, grocery stores really close. Like it's
tons of single family homes too. Yeah. And the prices of single family homes have gone up like 15 or 20% in the past 12 months. And that factors into how nice the neighborhood is. So you're going to get an influx of great, homeowners and good tenants. And I think that it's going to be a positive cycle that is going to help the area.
All right. Well, thank you everyone for coming and listening to us and asking questions. We really appreciate it. And we are taking commitments now. We have raised some money already.
I think we're already at a quarter of our ask.
Yeah, quarter. So we are looking for some. So if you know anyone else that would be interested in this opportunity too, we'd love to get in touch with them. And yeah, appreciate your interest and your support.
Awesome. Thank you guys so much.
Yeah.
Thanks, guys.
Thank
Thank you, Derek. Thanks, John.
Yeah, take care.
All right. Bye, guys.
All right. Have a great night.
Cynthia, I will send that over to you.
Yeah. Thanks, Rob. Thanks, Dan.